Thanks for tuning into Alpha Moguls, a show where we speak to some of the finest investing minds about how is it that they are thinking of portfolio construction to generate alpha. We kickstart this series with Samit Vartak of Sage One. Samit, great having you. Thank you for taking the time out.
It's a pleasure as always. Every year I've been doing this for a long time. Each time, I always look forward to this. So thank you for having me.
And the feeling is mutual for both for me and everybody at BQ as well as the viewers, Samit. So let me kickstart by asking you, when you're thinking of portfolio construct, the way the market is and then the texture of the market, the technicals of the market would also play an important part. Is the current market setup, the scenario, the texture slightly different from what you would have seen in the recent past?
Yes, you're right, Neeraj. I think these days, things move too quickly, and especially we have seen, 18 months, two periods of 18 months each post-COVID. So post-COVID, if you see, there are so many of those export-oriented sectors, like whether it's pharma, chemicals, IT, they were doing exceedingly well. And then we have the last 18 months when most of them have taken a significant beating, and many of the domestic oriented sectors, have done well. So 18 months, it's too short a cycle for things to play out. And, the things move too much towards extreme, so valuations across the board, if you look at the total market level, are still, I would say, especially after the run-up in the last couple of months, are back to, way above average. So the valuations are definitely, not that attractive. They're attractive in pockets, but you need to find those pockets where there is not too much herd and where there is not, too much excitement. I think that's the key, especially when cycles are so volatile, they're so swift and sharp. I think if you really want to beat the market, I think there is no option but to deviate from the herd.
Okay.
And for that, you definitely need to be a little contrarian. I think it's even more important these days, with the kind of efficiency which has improved in the market. The information that gets spread out is so quickly, and even the most new investor also get the same information, on a real-time basis as when the fund managers do get, which probably wasn't the case before. So a lot of, I think, data is completely commoditized. The spread of data, spread of research, any research report that one wants, I think today most of participants have access to it, right? So everyone gets the information at the same time, and unfortunately that probably boosts the herd mentality, because everyone gets the data at the same time, everyone gets bullish at the same time, and money flows into those, pockets very, very quickly. So if you are part of the same, herd, it's very difficult. It's getting more and more difficult to beat the market, and especially for fund managers, where there is a pretty significant impact cost. If too many people are buying at the same time, the impact cost takes away whatever alpha probably you were planning to make. So I think that's where, especially post-COVID, things have moved towards extreme, and one needs to definitely take that into consideration when you build a portfolio.
So therefore, even for keeping the stocks in your portfolio, because that's a currency, if you talk very, very blankly, or for buying into new things by virtue of the new money that you're getting, Samit, are you looking at companies relative to the current market-wide or the related peer set valuations? Or are you looking at, even when you're considering sectors, are you looking at valuations relative to what the historical valuations would have been? Because there are two ways to skin it, and a lot of people talk about historical valuations and current valuations and how stocks may still look cheap, even if they might on absolute basis be expensive relative to a lot of other things available in the market.
Right. No, you're right. I think, I really do not differentiate too much between sort of new money and existing money, because even existing money have that opportunity cost, right? And you can get out and get into newer stock. For me, it's important that you optimize your returns going forward. So for that, history is, sunk. It has no meaning for the future. Right. So, see, question is, um, of course, you would look for extremely attractive opportunities. When you add new opportunities, but for me, because I'm operating more on the small cap and mid caps side, where there tend to be much more volatility as well as many more multi-baggers. So the risk is higher, but also the potential of making outsized returns in stocks is possible. And hence, in a multi-baggers, sort of time period or time horizon, the multi-bagger time horizon is pretty long sometimes. It can play out in 2 years, or it can sometimes play out in 5 years or 10 years, right? So in your portfolio, there are going to be stocks which are somewhere in midst of that multi-bagger cycle. They may not be as attractive as they were maybe when you bought in, but things also change. So something which was available at a valuation of say 10 times PE, after 2 or 3 years, when the company has matured, it has become much less riskier, it has become larger, liquidity is higher. Doesn't mean that 25 or 30 times multiple is expensive. So you tend to hold those stocks because there are going to be older stocks where you expect them to be even become bigger multi-baggers as part of the portfolio. But then on the other side, you would be churning some part of your portfolio, right? So if you assume that you have 20 stocks in the portfolio and your churn rate is say 20%, then you would have about 4 stocks that you would be adding, or you'll be exiting during a year. So those are the stocks where you look for sort of outsized divergence, whether it's between the peers or even compared to its own historical averages. And that's where I would say that the new positions that you add, that's where you need to be a little more contrarian. You can take your time to build those, that position. But, that's where you have the opportunity. If you keep on adding the sort of the flavored stock, where everyone likes them, that will definitely not be adding any alpha, especially if you are a little late to the party. You need to be maybe a little early to the party and build your position slowly. But that's where you can, make outsized returns. I mean, for multi-bagger returns, you need 3 ingredients, right? One is low valuation starting point. Second is high earnings growth. And third is basically re-rating of the multiples, where you expect that multiple definitely is not going to depreciate. It's going to, improve going forward. So there has to be re-rating of multiples. And I have seen, in my last 11 years of history, all the multi-baggers, I don't remember a single multi-bagger where the starting sort of P multiple was, 30 times or 35 times. Most of the time, it has been closer to the single digit, so that's the starting point. And the P multiple would re-rate by, 2x or 3x. So, if the starting multiple was 10 and, over a 3-4 year period, the multiple itself is sort of a multi-bagger. And then you have earnings growth of say 20%, where the earnings will double in say 3 years or 4 years. And, that's how you do get multi-baggers. If you already enter at 35, 40 times kind of a multiple, then you can't expect it to be multi-bagger. I mean, there are going to be exceptions for sure. I mean, there has been Bajaj Finance where it was multi-bagger even when you bought it at much higher value, but those are exceptions. That's one in 2000 stocks, right? And if you try to pick or if you try to give that benefit to all these stocks, you'll make many more mistakes just to get that one. So, and that's not how you probably improve your probability of, finding multi-baggers, right? So for improving your probability, you have to have those, 3 ingredients when you enter. And that's only possible if you have a little contrarian view, you're early to the game, and you wait for the cycle to play out over the next 2 to 3 years.
Got it. I would love to understand, Samit, with markets at new highs, getting in those attractive starting valuations might be difficult, aside of the fact that they are probably happening in sectors which are completely out of favor. Now, firstly, the first part of my question, whether currently or even in the past, what is the proportion of steady state compounders which are not necessarily having the multi-bagger properties, because they may already have run up or they're still attractive even if they are not multi-baggers. So either said, but what is the proportion in your portfolio that you keep of these steady state compounders versus what is the proportion of the stocks where you have these multi-bagger opportunities as a part of the portfolio?
Right. No, I think that's a great question, because when a fund manager talks about his strategy, typically he will talk about like one thing, trying to find multi-bagger. But it's almost impossible to have all the 20 stocks as multi-baggers, right? At any point in time, whether you're talking of COVID lows or whether you're talking of sort of excited markets like today, right? So I've seen that in a 3 to 4 year investment horizon, right? Out of a 20 stock portfolio, even if you get 2 or 3 multi-baggers, and the rest of the portfolio delivers you an average market return, that itself creates 5 to 7% alpha. So that's what you look for, is that in a 3 to 4 year period, you at least find 2 to 3 multi-bagger stocks, which it's less than once a year, sort of. If you are able to find that, where that stock more than doubles during that time period, typically I would say that it has to at least go up. Most of the multi-baggers will at least go 3 to 4x in a 3 year period. Sometimes even in the lesser time period, right? So that's the goal. See, out of the 20 stock portfolio, there would be at least 50% of the stocks which are older, where they are absolutely not at the start of their multi-bagger journey, but they are somewhere in between. They are also not towards the end of the multi-bagger journey. But then the remainder 10 is where you look for those 2 or 3 stocks. So your hit rate, even if it's like 25%, that's reasonable enough. So that's what you try to find. But at least those 10 need to have that potential of those 3 ingredients of low P multiple, high earnings growth, and potential of re-rating of the P multiple.
Okay, so am I getting this correct, that when it comes to those opportunities or those kind of opportunities, or the dark horses, if you will, whichever way you term them, that's about less than 25% of your portfolio at a given point of time? You at least try to do it that way, because they may not necessarily move ahead in the same period of time that you want them to. They might move ahead with a gap of 6 months or 9 months or 12 months, and therefore that's about 25% of the portfolio on an average, or less than?
No, what I'm saying is that you may think that there is potential for certain percentage of your portfolio to become multi-baggers.
Sure.
Right? I'm targeting 2 to 3 stocks out of the 20 to be multi-baggers.
I get your point, but I'm just trying to think, Samit, that when you're starting off, there are some stocks that you acquire with a belief, okay, the starting valuations are low, the re-rating is possible, but it may happen with a bit of a lag. So what's the proportion of those stocks that you keep? The reason I ask this to you is because a lot of people might choose a lot of dark horses, and then the portfolio doesn't quite perform in the same way year after year after year.
Correct. Yeah, so that proportion typically is going to be 7 to 8 stocks. Out of those, I would expect, or sometimes 7 to 10 stocks is what you can consider, out of which I expect that 2 to 3 would become, because not all of them are going to become multi-baggers.
Okay. Now, trying to understand, in the current market context, when everything is trading very high, are you finding multi-bagger opportunities?
See, so there are pockets where I believe those will become multi-baggers. Surprisingly, there are extremes in this market. Some are extremely expensive, but there are pockets in the market which are extremely cheap. I mean, see, you may think that the markets have run up quite a lot, but if you remember, small cap index even in 2018 was up, I think had reached 9,600. Today it's 10,500, I think, somewhere around. So in a 5-year period, it's gone nowhere, right? So overall long-term returns for the small and mid caps have been extremely meager, right? So, and in my recent memo, I had written about the 3-year kind of a cycle, right? The cycle has repeated every 3 years. The peak of small cap index has repeated every 3 years. So whether you look at 2005, 2008, 2011, 2014, 15, then 2018, 2021. Next peaks would be somewhere, in the 2024-25 period. And the multi-baggers typically, occur more often during the up cycle. So in that 3-year period, the first 12-15 months is the correction period. And during that period, the correction on an average in these last 6 cycles has been about 45%. So there is a sharp correction in the small cap, right? This time from the peak in say end of 21 to the bottom towards late 2022 was about 33% drop, right? And from the bottom to the next peak, typically the run up is 2.7 times. This is for the Nifty small cap 100, right? So that means the index itself becomes a multi-bagger. So during that phase, it's possible that you will find many more multi-baggers compared to the sort of the correction phase. So I believe we are in that upcycle phase, from here on until maybe start of 2025, right? And hoping that the same kind of cycle, repeats. And there is no reason why it shouldn't happen. I mean, see, even today, if you look at, say, the top 100 stocks, the small cap index, which I call, say, from the 251st stock to, say, 750 stocks, those 500 stocks. Right? Even today, the discount of this small cap universe, is about 25% to the top 100 stocks. Right? And that's the average discount over the last sort of 10-year period. Discount is 25 to 30%, right? But the key difference is the return on equity today of that universe, small cap universe today, is about 15% compared to the large cap of 16%. So there is very little difference. Historically, if you look at the last 10 years, the small cap index return on equity has been around 12%. And then the large cap is around 16%. So large cap ROE is similar to what its last 10-year average is, but the small cap has improved significantly. The average discount of ROE of the top 100 and these 500 stocks has been about 35 to 40%. So today the difference is barely 7%. So you'd expect that, and still the price to book of small cap index is trading at almost 30% discount to the large cap universe. I'm talking about the median values here. So which I believe it doesn't probably deserve. And even the debt to equity ratio for the universe is below 0.2 times for these 500 stocks. So significantly improved balance sheet, significantly improved profitability, but the valuation gap still remains as historical. A lot of things have changed. There's been a lot of cleanup. Promoters, management have become much more prudent in protecting their businesses. This time, even if there was sort of a down period, they did not compromise on the margins. So there is significant improvement in the business, and valuation I don't think is reflecting as much as what's it's reflecting in the large cap space. So I don't know about returns for the entire index, but I think in the small cap space there are significant opportunities which are still available, and I believe we are in the right part of that 3-year cycle.
So are these opportunities available in pockets wherein the market has recognized them but not quite paying the full dividend, and therefore it is an opportunity? So the starting valuations may not be very juicy but still not very punchy, or are these available largely at the bombed out sector? And I know I'm focusing a lot more on the multi-bagger opportunities currently. We'll come to the other part also. But since we are on that topic, I just want to get that out of the way.
Right. No, I mean, for example, in power finance or power equipment side, or even small mid-cap metals play, many of these are, in terms of their balance sheet, at the best historical levels, but trading at significant discount to their last 10-year average. So these are really good businesses having, forget the power finance company, but even power equipment, some metals play, where it's very difficult for competitors to come in because they have long-term sort of licenses. They are debt-free, and the valuations are way below average. Most of them trade at significantly below sort of 1x price to book or single digit kind of a P multiple. Where I believe, given that their balance sheet has improved, and the growth has returned there. I don't think, given their balance sheet, it's not going to be as cyclical as what it historically has been. So those are the pockets. So I'm seeing in auto ancillary players where they're incrementally putting growth on the electric vehicle components. That's one. Power finance companies, gold finance, microfinance kind of companies, significantly below their sort of long-term averages, and metal space. Metal space, smaller metal space where they might be slightly vertically integrated, but in the last down cycle, they have significantly improved their balance sheet, and people still, I think, are valuing them as extremely risky commodities, which isn't the case given their balance sheet and the prudent management. So those are the pockets where I still find, I think, there are going to be multi-baggers in this space. And then, what we talk about is that reasonable valuation, but there is pretty huge potential. Those are the spaces like, the building materials that I've been talking about for a long period of time. Yes. Whether it's fabrication pipes, electrical cables, bearings going into say railways, industrials, or there are many other building materials, like stainless steel, which goes into, say, wagons, or there is a monopoly in India for stainless steel. So those are the places where they may not be cheap, but they're fairly valued, but significant growth is ahead of them. So that, overall, if I have to put it into a theme, I would say it's either build India, whether you're building factories or airports or bridges or railway, metros, roads, anything, data centers, factories, so either build India or build in India. So any foreigners who are coming into India, where obviously they would also need to put up their capacity. So niche, again, one needs to be very careful. If you are just trying to bet on basic building material where there is no limit of how many competitors can come in, so there has to be huge caveat that look for this kind of demand drivers, but the manufacturers or the service providers or the product providers, they need to be very limited. The number of players shouldn't increase. Whatever the growth potential that you see, the benefit should go down to these 2 or 3 players, and you need to bet on some of those dominant players. If that is the case, I think for some of that, we are at the start of that kind of a growth cycle. India has gone through pretty significant cleanup whether on the financial side, whether on many key industries, like real estate, and there have been a lot of regulations and power. The kind of improvement that you have seen on the power side in terms of defaults, losses, the gross NPAs on the power finance companies is I think missed by many investors, and we will reap the benefits going forward.
Should be interesting. Samit, last couple of questions. So one is on themes that either you've liked always or in the past, and where are you right now? So I know that you were pretty constructive on real estate and real estate-led ancillaries as well. Used to find a prominent place in your portfolio. I don't know about the current status, so would love an update there. And would love an update on chemicals, because you were very constructive at the right time back pre-COVID, and maybe a year post-COVID. I would love an update there.
Yes. So real estate, building materials, that side I'm extremely constructive as before. On the chemical and pharma space, we definitely were a little late to exit. So we got it wrong in terms of exit. We did benefit from chemical and pharma space for a long period of time. The first chemical company that I bought was in 2011-12. So we did ride. But then, again, we do keep on getting investors on a daily basis, right? So that benefit is not occurring to the newer investors. So companies like say Deepak Nitrite, if it goes to 3,000, I mean, it went from our initial buying price of 200 all the way up to 3,000. But then when it comes down to from 3,000 to 2,000, and any investor who bought at that level, sees a pretty big drop. So on chemical pharma space, we were very constructive, until mid of last year, but then realized that things have completely changed. Few of the things which changed the chemical space. One was post-COVID, there was pretty significant stocking up of, because there are a lot of logistical issues. So many pharma or chemical companies stocked up on inventory. So suddenly there was a lot of demand for, and then because of, shortages, the margins that these companies made were all-time high kind of margins. And they also made a lot of cash. So many companies ended up putting up new capex, and then post things normalized across the globe. There was destocking. At the same time, there was overcapacity, which is a double whammy, and the margins contracted, P multiples have contracted, and because there is oversupply because of overcapacity, even though the demand may normalize, but still there will be margin pressure because of overcapacity. So, that's something where we completely got it wrong in terms of exiting early. Right now we don't have too much chemical other than one-off plays that we have, but the portfolio is more geared towards the building materials, then the power infrastructure, power finance side, gold, microfinance side, and then completely sort of bottoms up plays wherever we are finding those pockets or one-off stories in overall. So that's how the portfolio is constructed. Overall, the valuations have significantly dropped because the newer additions that we have done are, I feel, has those three ingredients, to become multi-baggers. Not all of them are going to be, but at least from what I see now, there is potential to that. And of course, we can go wrong as we went wrong in terms of exiting chemical and pharma space.
Sure. Samit, one final question. There are some really long-term themes emerging. You spoke about data centers, presumably that's a long-term theme, etc. But an overarching thing that everybody talks about is this uptick in the per capita GDP of India from where we are right now to where we could be with all that's happening around. Now, since you need to be bullish to be in the equity markets. I'm presuming that, let's assume that that's a trend that does play out. Are you trying to incorporate some of those beneficiaries in the portfolio because they may have a long and a slightly slower but an elongated cycle? So I'm just trying to understand if you're doing that, and if so, how are you doing that?
Right. No, we are absolutely not doing it because I think those are really, really long cycles. That's not like 3, 4, 5 year kind of a cycle. I think such cycle predictability is more from a 10, 20, 30 year perspective. And I'm not even sure if those are the right numbers where, there is a pivotal jump, right? I mean, we can bet only on things where we are seeing. What we are seeing on ground is that there is a significant buildup of India by the government, by private players, and there is also significant interest of building in India. So there are foreign players who are coming in. So any sectors which will benefit from that, whether it's building materials, you would need much more power. So, finding place to play that kind of a theme is what we are betting on, because I feel those are much higher conviction, and there is much higher growth, even if there is significant, say, improvement in the demand side on the consumer side. But generally, it's, late in the cycle. Once India builds the infrastructure, the factories come in, and then there is employment which gets created. That is where, the salaries will go up, and then there will be consumption which will pick up. But I think that's, much later in the cycle. I think right now, it's too early for that to happen.
Got it. Samit, always a pleasure talking to you. Thank you for taking the time out and being with us on Alpha Moguls this season. And look forward to talk to you more often.
No, absolutely my pleasure. It didn't, I thought it just was 5 minutes and it's already more than half an hour. Thank you so much.
No, the pleasure was entirely ours, viewers. Thank you for tuning in to this inaugural episode of Alpha Moguls in the new season.